In this video, I want to talk about how to assess market conditions for the perfect entry and exit points. You want to use a market condition to determine, your entry and exit out of the market. That's what this video is all about. So assessing market conditions is crucial for determining the best time to enter or exit investments. You will need this particular data to determine precisely the best times to enter or exit your investments. By analyzing a combination of economic data, technical indicators, and market sentiments, investors can make informed decisions about when to buy or sell assets. Let's look at this video under a number of subheadings. Number one is analyze market trend. You analyze market trends. So in this case, we want to consider trend identification. Trend identification. So start by identifying the prevailing trend. It could be an upward trend. It might be a downward trend. It might be a sideways trend. It's not actually downward or upward. It's just sideways, like this in between. So an upward trend suggests potential buying opportunities, while a downward trend may signal selling or shorting opportunities. If you're a short seller, it is time for you to short, the stocks involved. And if you are not, it's time for you to, exit your positions completely, entirely. Then equally, consider moving averages. Moving averages. So you use a short-term and long-term moving averages. Example, the 50-day and the 200-day, moving averages to confirm the trend. When short-term averages cross, above long-term averages, it signals potential entry. Conversely, when short-term averages, cross below long-term averages, it may be time to exit the market. Although this particular aspect of investing is more relevant to traders, to people that are into trading, but for a fundamental investor, like what I personally practice, I don't consider all these. I don't analyze trends. I simply analyze company fundamentals and make a buy or sell decision based on the outcome. Number two is monitor key economic indicators. Monitor Monitor key economic indicators. In this case, you consider GDP growth. GDP growth. So a growing economy generally supports bullish market conditions, while a contraction suggests caution or a potential market downturn. So not only that, you discover the fact that whenever there's a growth in GDP, that means that the economy is doing very well, and a drop in GDP data will signify that the economy is not is on a downturn. We also talk about inflation and interest rate. So high inflation and rising interest rates can dampen market enthusiasm, leading to a lower entry point. So lower inflation and interest rates tend to foster market growth. Whenever there's a high level of inflation, discover that the economy would actually pick up. The economy will do very well. It perform well. So we also talk about unemployment rates. So low unemployment rates generally signals economic strength and may support higher entry points, while higher unemployment can be a sign of might be a sign for one to be very cautious. You should hold. You should really invest at that point. Just like take your time and see how the market performs, how things turns out in the economy. Number three is use technical indicators for timing. Use technical indicators for timing. These are for people that are interested in technical analysis. So in this case, you consider relative strength index. You may also talk about MSCD or the support and the resistance level. So when it comes to support and resistance, the support here is is a point where the stock price will not fall below. When the graphs of the price movement comes to that particular point, you discover that investors would very easily sight a buying opportunity. They would buy, at a higher level, and that will cause the price to pull up again. So when we talk about resistance, resistance is a point where the graph, when it hits a resistance level, the price graphs will now go up, will now go down. So the price hardly goes above resistance, and it hardly goes below the support level. So it kind of it moves between support and resistance, support and resistance, support and resistance. That's the way it is actually. So number 4 is watch market sentiment news. Watch market sentiment news. Generally, we live in an environment of should I say, information overload, but then you have to sift through what comes your way and determine what you feel could be beneficial to you as an investor. So in this case, you consider sentiment indicators. Please don't forget to subscribe to this channel and like this video. So we consider sentiment indicators. In this case, we have tools like the VIX, or what is called volatility index, or consumer sentiment survey. It can provide insight into investors' mood. It gives you an insight on how the investors are feeling at a particular how they feel at a particular point in time. So high volatility and fear might suggest selling or caution, while optimism might signal buying opportunities. Well, the matter is just that all these things I've discussed so far are relevant for those people who are into trading and speculation. But if you're actually a fundamentalist, a fundamental investor, you don't really need to rely on all these factors. You simply go to the company's financial reports and you look at the data there, the balance sheet, the cash flow statements, as well as the profit and loss statements. So all those things are what you will really consider, not these indicators that I'm trying to talk about, because personally I don't employ them. So you have news events, major geopolitical events, earning reports or central bank announcements can significantly impact market conditions. So assess how the market is reacting to these events to identify a potential entry or exit points. In this case, I would say, well, when it comes to any report is very, very important, as well as geopolitical events. So the most important factor here is the earning reports. When earning reports comes out, normally company publish reports about quarterly, every 3 months. So these are what really determine stock price movement, not all these other ones that traders rely on. Number 5 is consider seasonal and cyclical trends. Consider seasonal and cyclical trends. So seasonal trends, has to do with certain industries or sectors may perform better during specific times of the year. For example, retail, stocks often perform well during holiday seasons. That's some sectors that they do better or do well, depending on a given or a particular season, and they perform poorly, in another season. So for retail, sector, they perform very well, whenever is during the holiday season, people go out to buy things, and then it boosts sales in stores and the overall retail sector. You have a cyclical trend here. You need to understand the economic cycle actually, because as an investor, you're partly an economist, whether you like it or not. You understand basic economics. You don't need to go deep into economics, but the superficial, simple economic conditions, you should be able to understand those ones. For example, during a recession, defensive stocks may perform better, while cyclical stocks, example tech and consumer discretionaries, often outperform during periods of expansion. That's it. So you ask yourself which stocks do perform better in an expansionary environment, and which ones perform poorly in an economic contraction. Number six is risk management and diversification. In this case, you may employ stop loss. And stop loss here simply means that you peg a price at which your stock should not go below that. If your stop loss is $2, once your stock price is down and it gets to $2, the system will automatically sell off your stock, so you can never go below $2. It's a kind of it's a kind of risk management techniques. And then you also consider diversification. You can diversify across industries, you diversify across sectors, and you diversify it, across different regions. So you may also take into consideration number seven, market volume analysis and spikes. You consider how volume affects stock price. Usually a higher volume or a higher buying volume will then cause the stock price to climb, and a higher sales volume will cause the stock price to drop. So traders usually analyze volumes and all these things to be able to help them to make informed decisions. Personally, I don't really care much about the volume. I don't really attach so much importance on the volume. As I told us earlier, I base my decisions on the outcome of fundamental analysis. That is it, and then with less emphasis on trading volume and spikes.